Hi, I'm Phil Grandy at philsgang.com. Every day I do a short, they call them shorts, on Instagram and on YouTube, where I do a 1 minute piece. And they're very popular. Matter of fact, one of them hit over 100,000 last week. But what I'm going to do is try to do a recap on YouTube every Monday, so that on Monday you'll have my opinion as to what happened the week before the action, and then what we think is going to happen going forward. So this should be a big help to you between those shorts every day and then a recap every Monday of the previous week and my thinking of what's going to happen going forward. Hopefully this will assist you, okay, in making some better decisions. So let's start. Okay, so I said because of the bank term funding program, and I've been saying this all week, that emergency funding program, I believe we're going to be range bound for a while. Now, let me show you what I mean on my chart here. We could probably, if you look on this chart here, we're going to be range bound between 431 and 461. Now, that's because the banks, remember, are so important. In other words, with that bank funding emergency program, they are holding these banks up, the Federal Reserve, supporting these banks. Not going to be for long, but they're doing it right now. And banks, you got to understand, are the most important sector to the economy, to the stock market, because bank sector, okay, the Federal Reserve, okay, their job is to grow the economy and to grow it without inflation. Well, if the Federal Reserve prints their money and provide that money to all these banks, and then the bank supplies money to you, called money supply, and the idea is most of that money is going to find its way into business investment, where small businesses, large businesses take that money, and that business investment, new equipment, and so forth, increases productivity. Increases the productivity, but also increases jobs, increases wages, increases savings, and increases spending. And that's how we grow. So it's always been the most important tool to keep inflation down, as long as that money went to business investment. Now, to understand where we are today, you got to go back to 2008 after the crash. In 2008, after the crash, they made a decision not to go to the business investment. Who's they? The 1%, the richest 1%. They control everything. They control the Federal Reserve, they control the banks, they control the papers, they control magazines, they control everything. So that richest 1% made a decision, look, hey, wait a minute. I lost trillions of dollars and millions of dollars in the 2008 crash. I want my money back first. Now, guess who the richest 1% is? Most of the congressmen, like Pelosi. So they said, let's do this. Let's take and we'll print all this money, and instead of putting it into business investment, let's put it into QE, where we can take that money, go buy 10-year treasuries, and when the 10-year treasury yield drops, we can force it to drop, then the Federal Reserve, we can take the short-term rate, our rate, which is different than the 10-year, our short-term rate, 3-month treasuries, and drop it down to 0. And when it's at 0, we can then take and loan all this money to corporations to buy their stocks, their own stocks. Because the way it works, when you have 1 million shares of stocks and your stock's trading at $10, if you go and purchase your stocks and drop it from 1 million to 800,000, then your stock is going to go up from 10 to 20 without earnings or profits, because what a company does is just taking those shares out of the system. That automatically pushes up earnings and pushes up your stock price, called a bubble. Now, it was Obama and Bernanke who said in 2009, let's not take this money and do business investment. Let's take this money and put it into QE. And because that was their target. Because remember, it was the richest 1% who put them into office. So that's what they did. So again, you got to remember the bank's role in all of this. If you get away from that role of growing the economy without inflation, you're screwed. But that's what they did with QE. And here's the other thing they did with QE. They also knew that they could put it over on the public. What's that mean? Well, they said, look, the public's going to be happy. They don't know they're getting screwed. For the first time, they can buy a house at a mortgage rate of 2.3, 2.4%. They can buy a car. They can buy a wave runner. They can buy furniture, things they couldn't buy previously because rates were too high. But when you bring interest rates down this low, they're going to be happy. So we can mask what we're really doing and tell them this is really good for them, because they won't care that we, the richest 1%, are going to get richer. Because remember, every time they print money to buy treasuries, to drop the interest yields down, to drop the rate down on the Fed rate, that is inflation. Printing money is inflation. Let me tell you about inflation. Every president, except for Obama, started with Obama. Inflation was the scariest thing. Every president said, there's nothing worse than inflation. It's worse than war, worse than terrorism, because it can destroy your economy faster than a war. But Obama, when he started with this zero rates, okay, remember who he's dealing with and who he's kowtowing to, right? It was the richest 1%. So let's move it forward. So as QE went along, remember what's happening. Interest rates start climbing. Inflation keeps climbing and climbing. Now, what do you do when inflation climbs? What tool do you use? You raise rates. So what was only supposed to be QE for a year, even less, actually, they said, Obama came out and said it's going to do it for about 6 months to a year, turned out to be 12 years. Inflation got worse and worse. So, especially in 2020, when the pandemic hit in 2020, all of a sudden they had to stimulate the economy again, print even more money. Print all kinds of money so they could throw it at the economy. Inflation got worse. Now, all of a sudden, the stock portfolios of the very wealthy, especially the tech portfolio, the tech stocks in these portfolios of the richest 1%, their worth in 2022 climbed to $23 trillion. But at the same time, they were controlling almost 54% of the individual held shares. At the same time, the working folks on Main Street were getting screwed because inflation was going up towards the roof. Gasoline was going up, everything was going up. Now, they still didn't figure out, Main Street still didn't figure out, they were again duped since 2008. This whole program of QE was to only enrich the very, very wealthy and mask it, because by keeping these interest rates low, people thought on Main Street it's a good deal for them when it wasn't. So 2022, the richest 1%, their wealth, the worth of their stocks went up to $23 trillion. Now, this doesn't count all their other assets. It doesn't count their vineyards, their agricultural land, their timberland, their diamonds. Because remember, that's how they create wealth, through asset appreciation. And how do assets appreciate? Inflation. And what was the other reason why Obama wanted to create all this inflation, because he was left with a tremendous amount of debt from that dope called Bush. Tremendous debt. He wanted to pay that debt off, but here's the problem. When you have inflation, or the good thing, when you have inflation, dollar value goes down. So that means Obama's looking at the debt and saying, wait a minute, I don't have to write a check to reduce the debt we owe to China. That debt will come down on its own because inflation destroys the value of the dollar. So if I owe China 1 million, all of a sudden I only owe them 800,000. So he was aligned with the richest 1%. The richest 1%, they benefited from high inflation as their assets went up. Obama benefited from high inflation because he didn't have to pay the debt down. The dollar that was collapsing, getting weaker, was paying the debt down for him. Who was suffering was Main Street, but they didn't realize that until now, that they were duped. So now the bust is coming. So what we saw yesterday, where the market rallied, and we're talking on 9/14, we already saw back on August 29th. If you remember, on August 29th to September 1st, August 29th, prior to that, we were being told every day, hey, things are terrific. Things are terrific because why? Well, we're not going to get a recession. We're going to have a soft landing because job openings were strong. Wages were strong. Our economy was strong, was growing. This was the lie they were telling us. But then on August 29th, what happened? We got the reports. It was a myth. It was all a myth. None of that was strong. So everybody's waiting for the market to fall, but the market goes up from August 29th to September 1st. Why? Because the fake business news network were able to spin bad news into good news. They said, oh, but wait a minute, don't sell your stocks. This is good news because now they're not going to raise rates. They're not going to raise rates now because things are getting worse. They're not going to raise rates. And the market went up 4 days in a row. It gave it all back. Yesterday, we have the PPI number come out, inflation number. Inflation goes up, ready for the market to go down. You say, oh, no, wait a minute. This is good news. Gee, this means if you take out food and you take out energy, then that means that inflation is going down. You know, just don't eat food, don't gas your car. But this is what they said yesterday. Are you kidding me? So what they did is they took that bad news, inflation news going up, and they twisted it like they did on August 29th. They say, oh, this bad news is good news. They're not going to raise rates because inflation's going up. And then yesterday, the retail numbers come out. Inflation everywhere in retail. Waiting for the market to go down. They said, oh, no, don't worry. This bad news has turned to good news because you want to know why? Because guess what's in retail? Gasoline. If we just remove the gasoline, there's no inflation. We have a Goldilocks economy with diminishing inflation. Just take the gasoline out. Just like any other number, take out food and energy, and everything's fine. And the market rallied. Market rallied. This is how crazy it is. How crazy it is. So this is going to be very interesting to see. This market is going to crash. There's no question about it. Here, let me show you something on my charts. Boy, people are getting duped from 2008 up to now. Now the consumer's finding out that cheap car he could buy and that house, he's going to have to give it back. He was duped. If you go back to 2008, if you go back here, let me just put a little arrow up here for you so you can see it. Sorry about that. If you go back to 2008, right here, the crash, 2000, 2007, 2008, this is when they started. They said, let's not do what we have always done is print money and let's give it to the banks, and the banks, the Federal Reserve will give it to all the banks, and the banks will do business, give it to businesses that will have business investment, increase productivity, wages, so forth, and everything will be fine. They said, screw that. Let's screw Main Street, us, the richest 1%, who are also in Congress. This is where they decided to let's create inflation. And as I said, Obama was for it for two reasons. One, he could get the debt that was left behind reduced without writing checks, and his richest 1% who put him in office, they're going to be happy. So as long as the 10-year Treasury yield, kept going, it stayed at about 1.6%, okay? Let me just put this up. So as long as they could keep that Treasury yield to 1.6%, then the market would go up. As soon as they drove that 10-year Treasury yield above 1.6%, look what happened. 2018, the market dropped. And I predicted that in January 2018, this would be the beginning of the end. And when they moved the inflation, they moved up the 10-year Treasury yield, and they moved up the 3-month Treasury yield, boom, the market dropped 20% 2018. They moved interest rates back to zero. More QE. Market rallied again. 2020. Instead of at 1.6% the 10-year Treasury and the 3-month Treasury at 0.1%, they moved those rates up. Because remember, they wanted to start fighting this inflation. As soon as they started inflation, boom, 2020, the market dropped 30%. They dropped rates back from 1.6, 1.7, and the 3-month Treasury from 1.25 back to zero. Market rallied again into January 2022. 2022, guess what? Again, above 1.6%, the market collapsed. So think about this. Every time that they moved the 10-year Treasury yield above 1.6%, and every time they took the Fed rate and moved it above 0.1%, the market would fail. Now, here we are. This is where we are right now, right here. And the 10-year Treasury yield is now, think about it, at 4.3, not 1.6. And the 3-month Treasury is over 5%, not 0.1%. So this market dropped every time, when the inflation, when the yields got above that 1.6 and the 3-month Treasury got above 0.1%. Look where we are. This is insane where we are now. So now what they're doing is they came in and they built a bridge, okay? I call it the steel I-beam pattern. What they did is come in, the Fed, and said, we got to hold this market right here because we are now into a pre-election of 224 moment. So they built the steel I-beam pattern to try to hold the market up. What is that? Bail the banks out. Bail the banks out. And that banking program, the emergency bank funding program, is what is holding this crash back. But it's not going to work. It's temporary. And at the same time, what are they doing? Powell is doing what they call more QE. They're calling it stealth QE. He's taking the interest income from his balance sheet and he's buying treasuries just like they did in 2008 all the way up to 2012, buying 10-year treasury, trying to get the yields down to hold the stock market up. And then lastly, what are they doing? They're trying to replace the bank stocks as the leader with tech stocks. Because remember, the bank stocks are going to get worse and worse because we got all this commercial real estate that's really bad. I mean, we got car loans right now, they're in default. Credit card loans in default, just going to get worse. So they're trying to replace the leadership, which is the banks, with tech. It's not going to work. So what are they doing? You take all the big hedge funds, the 401k pension and the 401k funds, the pension funds, all these guys are getting insurance guys, all getting together and they're pulling money. The last time they pulled was 15 trillion to buy Apple and Microsoft and Nvidia to keep these stocks up. So this guy is going to drop. You just got to be patient, okay? It's going to pull all the way back, okay? Remember, I believe, to where the support has always been, right here. This is when the market started to break down, right here. See it? So that's where we stand. So going forward, I think we're going to be in this narrow trading range, which you can do very well, make a lot of money in a trading range of stock. But you got to know how to sell short, okay? You got to know how to sell short. And so that's really it. I'm going to report to you next week. Again, I'll give you a recap. But in the meantime, during the week, remember, check out my shorts, not short selling, but my shorts, little short segments. They're a minute long on Instagram and on YouTube. They're very popular. And for more information on my stock picks, my radio show, my color-coded chart, our program of teaching, click the link in my bio. So I hope this will be some help, because what you're getting here is the truth. You're not getting, the bullshit that we're getting every day from these clowns, okay, on the fake business news network. Their interest isn't your interest. Remember that, okay? All right, see you on the charts. philsgang.com.